The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Thanks so much for joining us here. We only got about half of the folks that have signed up on the line here, so we're going to give it a couple more minutes, and then we'll get started. And again, thanks so much for joining us. All right. Well, it looks like we've got a hefty number of people here, so I think we'll go ahead and get started. Want to just again start by letting you all know that we really appreciate you taking the time to join us today. Some of you folks may have attempted to participate in this webinar last week, and we did have some technical difficulties, so some folks weren't able to participate, and we also had some issues with the recording of the audio. So a little makeup session here, and it's actually had quite a bit of interest. So we're happy to put this on again. My name is Chris Anderson, and I'm MCT's Chief Administrative Officer. In addition to running, administrative operations, I also oversee our integrations programming team, as well as our outsourced lock test division. So I've had the opportunity to take a look at the registration list, and I recognize a lot of those names out there. So I think we've got a great session ahead of us with some good folks to participate. Before we get started, just a couple of quick housekeeping items. One, we will be sending out the slide deck for this presentation later today. And we'll also be sending out a full video and audio link. Again, that'll be in a few days down the road, but that will be coming as well. So don't worry if you miss something. We'll be getting you that information again soon. If you do have questions throughout the presentation, if you could please just type them into the chat window that is in the bottom of the GoToWebinar menu. And then we'll do our best to get those questions addressed in our Q&A session at the end of the presentation. So I think, pretty much everyone is on the same page here. You really can't read a Chrisman or a Garrett McCauley email or take a look at the MBA stats or read Housing Wire or really any, industry publication without hearing about margin compression and loan officer compensation. It's a problem facing the industry as a whole. Now, the good thing for everyone on the call today is that you're already ahead of the game because you're hedging or on your way to hedging. So you're already realizing higher gains than your best effort counterparties are. And while a hedge advisory firm wouldn't necessarily consider this hosting this webinar as part of their typical responsibilities to their client, everyone on the MCT management team really feels strongly that as your capital markets partner, we want to do everything we can to help you be successful. So this is actually one of a few webinars and resources that we're going to be sharing over the next several months that deal specifically with this issue. Today, we're going to have a discussion about general market conditions that are affecting margins, and that's going to be led by Bill Petersohn, who's one of our managing directors on our executive team and also oversees our business intelligence unit, so along with a lot of other things. And we've also arranged for two of our industry partners that we've heard from our clients have provided them with some help addressing these issues. So we're going to be hearing from Mark Wilson, who is a certified public accountant. He's a specialist in mortgage banking and hedge accounting, and he's also the founder of Mortgage Banking CPA. He's going to discuss some of the strategies that he has consulted and implemented with some of our mutual clients to help address LO comp and margin compression. We also have Mike Lewis, who is the Chief Operating Officer of ATI, along with Aliya Nurani, who is in software development for ATI. And ATI, or Awesome Technologies, Inc., is a LOS consulting firm and a software developer. They're going to be showing us a tool that some of our mutual clients have been using successfully to help streamline their LO comp process and gain visibility into their true costs, who their most profitable branches are, loan officers, et cetera, what their true costs are. So they're going to be showing us that tool, which is called Ecom today. And that is far too much of having to listen to me talk, I'm sure. So why don't I turn it on over to Mr. Petersohn here. And Bill, why don't you take it away, sir?
Okay, thanks, Chris. So at MCT, what we had seen over the last couple months, Q1, Q2 in particular, was the margin compression. We saw, as Chris pointed out in the earlier, he's saying, you can't read a Chrisman or another article about the issue of margin. We all know that everyone had margin compression in particularly the first and even into the second quarter. So the real question is, why and why that happened, what happened, what caused that? At MCT, a lot of our clients, were managing their hedge, were managing their profitability. They were calling in, asking these questions. So we felt it important to be able to explain what happened and why. Ian, if you can advance the screen. So essentially, from Q1, beginning of Q1, just to the end of Q2 this year, just in general, Treasury yields are up 45 basis points. So essentially, rates are rising. If you even start back in Q4 of 2017, rates definitely went up. We're a little lower even before, and now have gone up. So rates have increased from Q4 2017 all the way to present day. Increase in the rates is going to lead to that decrease in the TBA pricing, which ultimately feeds your loan pricing that you're getting from the investors. So I have up on the screen that the Fannie 4 coupon essentially dropped from a 104.6 price all the way down to 102. So almost 250 basis points. We've seen the drop in the Fannie 4 coupon. So rise in rates, drop in price. Now, is the price dropping faster than normal? We think so. We know so. And it appears that in Q1, Q2, as I have in the bullet point, that a lot of originators were still trying to capture volume, beginning of the year, trying to make sure they got that loan. So essentially, they were locking loans at these lower rates and not making the margins that probably as a company you wanted to obtain. So, and even our client data, we were able to look back from Q4 2017 to present that the initial lock price, your lock best effort price, was down over 50 basis points from the end of Q4 all the way to present day. So people were locking loans for less. Rates are dropping, rates are rising. We're trying to hold on to the lower rates, and you're really getting those lower prices on the loans, which really caused a lot of that loss on your end on the accounting side. Just as another point that we saw in our database, starting in Q4 2017, the average conventional 30-year lock, that note rate was around 4 1/8, and end of right now, present day June, we're seeing 4 7/8 as the average 30-year conventional note rate. So we're seeing that, obviously, again, the rise in rates, the drop in pricing, but the drop in pricing is happening faster and faster, unlike past years when we've seen this type of rise in rates. So why did this TBA price drop significantly? So Ian, if you could advance the slide. So this is just showing you on the slide the three different TBAs that are commonly traded: a 3.5 coupon at the bottom in that pinkish looking color, the 4 in the middle, and the 4.5 up top. And you can see December 1 of 17 to Feb 1, 18, and a little bit after that, it's that real sharp drop in price. That was that margin compression that I think everyone felt, where rates rose, but the prices dropped a lot faster. So the data of the TBAs, you can see it showing it there. The rest of the graphs on both sides of that, from like December even into March or April of 18, they're just normal movements, but it just was such a sharp movement in from Jan 1 all the way into, through the first quarter, March, and even into, maybe even May and April, that they had these drops. So graphically, that's what's showing there. If you advance the slide, Ian, we could talk about why. Why did that happen? What were the outside factors? So essentially, the biggest factor for the margin compression was that the demand for mortgage-backed securities has dropped significantly for a couple of reasons. The big one is the Fed Reserve balance sheet. Up until end of this last year, the Fed was a big buyer of mortgage-backed securities, helped us get out of the recession in 2007-8 that took place by buying a lot of these MBSs. Now the Fed is on the opposite end. They're no longer buying, but they're letting their balance sheet run off. And you can see I have some notes here that they're allowing about $12 billion of runoff each month, which is by the end of the year will be $20 billion. So essentially there's an oversupply or less demand for the MBSs, which go back to your Eco 101 supply and demand curves. If you move one of them, move the demand to the left, decrease the demand or increase the supply, it's going to have an effect on the price, and that effect is the drop in the price for the TBAs, which TBAs are the forward contracts that are going to make up the mortgage-backed securities. So huge decrease in the demand for the MBSs. The other issue also affecting the demand of the MBSs is the flattening yield curve. The spread between the 2-year and the 10-year is narrowing. So the folks that buy the MBSs, other than the Federal Reserve, like banks and REITs, their big game is to make money on the spread of interest rates. Big buyers of MBSs, so of the long-term rate, and they use short-term rates to borrow. So they, with low short-term rates, you turn around and you borrow and you invest at long-term rates. If the yield curve's flattening, that spread is going to narrow and decrease. And that has had a significant impact on the demand for MBSs. Banks are no longer putting their money to use that way, and they're looking for other vehicles. And REITs, who are traditional buyers of MBS, I mean, they have over 300 billion of MBS in their portfolio, are no longer seeing that spread. So the flattening yield curve makes the MBSs less attractive, therefore decreasing the demand. Federal Reserve, the runoff on the balance sheet, same thing. That's what created that real sharp compression that everyone experienced in the first quarter. Ian, if you were to advance one more slide. This is just a graph of the 2-year and the 10-year Treasury yields, showing that in October, you could see, the orange line and the blue line, a wide spread there. As you go into August, close to August of 18, that's narrowed. So that's showing the narrowing of the short term versus like a long term in the yield curve. And below that is the spread, just calculated for you, showing how at one point it was as wide as over 100 basis points. Now it's under 40. So again, affecting the spread getting narrower, affecting the demand for MBSs. So that was really the reason for why it happened. Next, we'll turn it over to I guess it's Mark Wilson, to kind of talk about how to manage through that now that margins are less. How do you manage that? How do you work with that?
Yeah, and Bill, before we turn it over to their Mark there, I just wanted to double check with you. I may not have heard it, but I understand you and your team have been working on a white paper that goes into more detail around this, and that's something that'll be forthcoming in the next several weeks. Is that correct, sir?
Yeah, thanks for reminding me. I forgot to mention that. Yeah, so we've gone through our client analytics, showing a lot of the detail, explaining and showing where people were, where they are, where they are, along with this information. And so it's a white paper really laying this out as to what happened and why. People are asking, is it going to happen again? What's it look like? And it's an explanation of what happened. Nobody's fault. It's really a function of the economy.
Well, that's awesome, Bill. Great information and insight there on kind of what's going on out there in the market. And as you said, we'll turn it over to Mark Wilson now. And Mark, if you wouldn't mind, just a little introduction, and then talk about how you've been helping some of our clients with a consultative approach to help strategize and come up with some ways in which to deal with these issues, sir. That'd be great.
Yeah, sure thing. Go ahead and why don't we? So real quick about us. This is a little bit of background, and if you want to read about that, that will be in the slide deck. But Ian, let's go to the next slide. Some quick background on our firm. Mortgage Banking CPAs is the consulting arm of CWDL Certified Public Accountants, and our firm is your traditional CPA firm and consulting firm that provides services to small independent mortgage bankers all the way up to some large institutions on the consulting side. We are absolutely dedicated to this space, and we spend a lot of time with mortgage bankers and dealing with these exact issues. And we just got back from the Western Secretary and, learned a lot of new information, but confirmed a lot of things that we're seeing with our current client base. And so that's a little bit about our firm, but let's jump into these particular issues. Ian, would you go to the next slide? So as Bill was saying, margins are down, and so what? We have some clients that will tell us, margins are down, but our corporate margin is fixed. And if our target margin on our loans is 200 basis points, as long as the loan officer can sell it, we're fine. And so we make sure that we have enough margin. And my answer to that always is how positive are you that your corporate margins have remained the same? What are you looking at to determine that you're not being adversely affected by your gross price going down, fewer deals, increased interest rates, and loan officer concessions and all of those things to drive additional loans through the door. As Bill said in his slides, if gross margins are off by 50 basis points, and if that's what you're experiencing, and your loan officer comp has remained the same, and your cost to manufacture that loan has remained the same, then your net profit overall has to have gone down. And so those are things that we think you should really take a look at and make sure that you're paying attention to it. Obviously, you have profitability covenants. You're in business to make money, and the company being profitable obviously is good for everybody involved. So it's really important now more than ever to make sure that you're paying attention to those things. And the loan officer compensation, if all other things remain the same, is the only additional area you can go to come up with that deterioration of your profitability. So it's a good time to look at your business model. Like I said, he's returned from the Western Secondary in San Francisco, and many mortgage bankers have been experiencing this. And let's go ahead and talk about how to manage it and a little bit about what we learned while we're there. Ian, let's go to the next slide. So while we're there, we asked people, the secondary executives, what are their loan officer performance targets in terms of closed loans per quarter and the median compensation per loan. And of course, the responses varied by geography and business models and level of marketing support. For example, the average target for a standard West Coast LO who generated his or her own business was between 5 to 9 loans per quarter, where retail operations with strong lead generation engines had targets where they received twice as high. And we see that in our client base. I mean, we see that across the board. Sometimes it's different, and every business model is a little bit different. But the comp per LO there are some varying numbers there. But the average LO received about 125 basis points per low in some of the Western metropolitan areas, and some of the Southeast is a little bit higher because of the lower loan amounts, around 200 basis points. But although there's varying degrees of what the compensation plans are by region and area, and some are exceptions to the rule, they all agreed that they think the LO compensation in the future is going to change. Some of them predicted that it's going to be down 30 to 40 basis points overall. And the question is what's leading to this change in LO comp? I think obviously we talked about if your gross price per loan has gone down, you have to make that up somewhere. And in addition to that, the relationship between the customer, I mean, the loan officer of the future might not have the same significance as they do today. Who owns that borrower relationship? Is it the real estate professional? Is it the company? Or is it going to continue to be the loan officer where the business is born and brought into the company? And from that, those are questions as the mortgage operator you have to ask yourself and find, where the right opportunity exists for you in those questions. In addition, technology is being improved on a daily basis, which means putting together the loan is, it's becoming, more dependent on the actual technology. And so maybe manufacturing that loan, there'll be increased efficiencies, and so that will drive some additional profitability. But all of those things would lead to the high compensation for loan officers to be reduced. So the question is what can you do? I mean, if you're looking at your current loan officers as it relates to compensation, what are some things you should be doing to make sure that it's that your model is working correctly? Ian, let's jump to that next slide. So we recommend have a true profitability model. So what that means is you run profitability by loan officer, by product type, by branch, and you make sure that a loan officer might be originating a ton of business, but maybe it's a non-profitable product. It's a bunch, it could be state bond programs, or and how that relates to your operating overhead. A non-producing loan officer takes up additional support staff at varying degrees. So you need to really ask yourself: is it necessary to carry these additional loan officers who might just be sucking up your profit because they're not producing enough business to make it worth your time? And then obviously we touched on this a little bit before, but knowing who your customer is it the loan officer, the real estate professional, or the borrower, and focusing your attention on what will drive the profit to your company. What's the best use of your money and your investment dollars, and really getting into the details to understand what fits into your profitability model. And the second thing that we think you should do is make sure you educate your loan officers. We met with a group out at the Western Second Day, and we were talking about the risks of reducing loan officer compensation and what that might do to your company. And there's a real fear that production will leave. Good branches will go away. And over the last 10 years, everybody's been pushing really hard to bring on additional branches and production groups. And that's still happening. There's still a lot of that going on. There's some consolidation. So there's opportunities for even everybody on this call to get additional production. But is it the production you want? And having an open discussion with your loan officers to understand, what it takes to be profitable and why it's important for them, for the company to be profitable. What's in it for the loan officer? Obviously, if they're with a company that can be profitable, they can support them in a bigger way over the long run. And the individual who had just lowered the loan officer comp earlier this year he said that he hadn't lost any of his best loan officers because they were aligned on what the direction of the company, what the company's goals were, and where they were trying to get to. And then he was also open to the idea of trimming out the fat. Get rid of those non-producers, those bottom 20 or 30%. That is taking up space and time and slowing down your production group, and not supporting your best loan officers, the ones that are driving your profitability, allowing you to do a loan for less, and getting you to a place of profitability. And we enter those contracts all the time where we go in and we run these profitability models, and we start to see trends that pop out at us, and we think that's an important exercise for everybody to run through. And once the loan officer understands how they fit into that profitability model, it's interesting to see what happens. And so number 3, it's to hold your loan officers and your branches accountable. We met with a group recently that had substantial problems with their branch operations. They had nearly 30 branches that weren't profitable. A short year later, and they actually have greater net profit this year than they did last year, simply by having forecasted models out for their branches and then holding the people that are running those branches accountable. And so, when you run into an environment where margins are compressed and the cost to manufacture a loan isn't necessarily gone down unless you've implemented some efficiency improvements like outsourcing and other things, you need to make sure that everybody is aligned on the company being profitable. So, that goes to having a good culture and having everybody understand what the goal is and driving them towards that goal. And make sure that the people understand that process. If they're not meeting their particular forecast, is there a process in place to get them there? And is there a process in place to invite them to leave if they can't get to whatever you're forecasting or what they need to get to? Because remember, if you have people in your organization that continue to not be profitable, or they're just another, few $1 million a month to break even, how far are they actually making a profit? And in our world, we tell people net break even is at least 10% net profit, because it takes at least 10% of profit to continue to cycle through your cash needs and goals for your company. So I know I said this before, but did I say trim the fat? Get rid of the ones that are dragging you down. Communicate, help them understand, keep them informed of where they're at, and then also give them their target KPI. What is the number they need to hit to be able to have all the things they want to have to be able to do their business. So these are the three kind of basic but very important things that we're seeing companies that are following these steps and paying close attention to it and building out the profitability model are profitable. We have lots of clients that are doing well. They're continuing to bring on branches. They're continuing to grow. And even in this environment, you can do that, but having a process in place to do that is really, really critical. And having the courage to get rid of the people that are not getting you to where you need to go. And I'm talking about from the production side, right? So those are three
Mark,
things.
Mark, sorry, it's Chris here. I just wanted to ask you two quick questions. One, that trim the fat stuff has nothing to do with the fact that I'm 290 pounds, right?
Well, I mean, it wouldn't hurt you, Chris. I mean, you look great. I'm just kidding.
And two, you've talked about some of these engagements. By the way, thank you all the rest of the panelists for not laughing at my joke. That was awesome. But I know you've been involved with a lot of these engagements with our clients. And what is a typical kind of time frame there? Are you guys able to provide, kind of a quick look stuff, and then you engage on a longer? What does a typical engagement look like?
Yeah, so it depends on the particular engagement, but usually if we go in and the goal is to get the company to profitability, it's usually a 4-week consulting engagement where we go in and we look at all the business processes. We understand who are the key components in the company. We understand the compensation plans, pricing strategies, and then we compare that to what some of the best industry standards we see for the size of the company and the complexity of the environment they operate in. And we provide a business case at the end of that engagement to give them an opportunity to either implement that themselves or have us help them implement that if they need us
Mark,
to do that.
one other quick question here. You can do all of this wonderful analysis, but if the clients that you're working with can't get you the data out of their systems, it's kind of all for naught. So are you kind of equipped or able to help with, kind of extracting some of that data, or do you have any tools that are already built that help the client extract the data?
Yeah, we have some software we've developed that integrates with LOS and origination and the accounting software. So we're familiar with all the technologies that exist out there, from A&B and Loan Vision, even some guys on QuickBooks, and integrate with their various LOS systems, and we pull our reports from MCT too to help determine some of the clues to decide what's going on in the company. We lean heavily on that, absolutely. Yeah, and there's also, when you're comparing loan officer compensation and make sure that you're being profitable from that perspective, there are, I know, awesome technologies. I think they're coming up next, has a great commission module to help manage that, and some really good business intelligence tools built into that. But we've also developed some internally built out KPIs that we feel are really, really important. And KPIs are key performance indicators for those people who don't know what I'm talking about, but to help really drive decisions in the company, and kind of forecast and understand what's happening before it happens. So some leading indicators, so companies can really focus on what they're good at, and that's driving business and being profitable.
Great. Do you have any more slides here, sir?
No.
This is the important one. So
Yeah.
this is how you can get a hold of Mark if you need to, right?
Yep, that's us. So if you need us, that's where we're at.
So you actually started, thank you, by introducing that ATI has some tools, and I think we were touching on it, that the data that comes out of your systems, if you don't have that accurate data, you're really you're at a disadvantage. And one of the things that I was sort of surprised by is, even in this day and age now, with all the technology people are implementing, we really see a lot of inefficiencies when it comes to actually determining LO compensation. So we've got Michael Lewis again and Aliya Nurani that are going to talk a little bit about eCom, which is a tool that many of our clients have been using successfully. And Michael, have we got you there, sir?
We do. Thank you, Chris. Appreciate that kind introduction. And I'd like to just take a minute and thank Ian and the MCT family as well for organizing the webinar and giving us this opportunity to showcase one of the awesome technology products we offer to address this growing market compression concern addressed so well by Bill and Mark today. Today's product, eCom, is our employee commission and onboarding management tracking system. And our global product manager, Aliya Nurani, will spend the next few minutes providing a brief overview to some of its key functionality and possible workflow configurations. But before she begins, I want to just mention that Awesome Technologies will be showcasing our flagship business intelligence product called Bullseye to those of you who will be attending the 2018 Digital Mortgage Conference on September 17th and 18th in Las Vegas. So as with any of these products or system administrative or custom development services that we offer, we invite you to contact us for a more in-depth analysis and to learn more of how we might be able to partner together to solve some of these business needs. And with that, I'll turn the time over to Aliya.
Yeah, and I of course, am going to interrupt right there because I can't help but love hearing the sound of my own voice, even though I'm getting over a cold. You did bring up Bullseye. And I know that eCom is sort of, one piece of really having a good, clean, business intelligence tool, optics into your company. So I actually have had the opportunity to demo Bullseye and actually I've seen it implemented with some of my clients as well. And so I certainly do encourage you folks to talk to Mike and his team about Bullseye. But I think what's great is that all of these these tools are all just under the same kind of common goal of giving you better insight and cleaner and tighter data. So Aliya, you want to run with it?
Sure. Ian, if you don't mind, can I present so I can also jump into the system instead of just going off of a PowerPoint?
Absolutely, absolutely. Here you are, Aliya.
Thank you so much. Okay, I hope everyone can see the screen here. So we'll start off in PowerPoint and then I'll jump into eCom itself. So recently we implemented eCom for a client who had 81 active loan officers across 15 branches at implementation time. In addition, they have a handful of loan officer assistants, processors, and underwriters on their operation team. Combining the sales and operation teams, they have over 120 commission structures between the teams. Their management system of maintaining the plans and dates of implementation were tracked in a spreadsheet like you see here in the blue. It spanned across many columns and it was getting increasingly difficult to track. When it came time to calculating the payouts, they used Excel and tracked the changes through email. Previous to implementation, the process was taking them 12 days to complete commissions on a bi-monthly payment schedule. With the implementation of eCom, their entire system is now automated and their commissions are completed in 3 days. eCom has been designed with the... Yes.
Aliya, I apologize. I just want to go back to that previous slide for just a moment because what I think I hear you saying is that my 50 different spreadsheets that I used to build out of my LOS and my payroll and all of those wonderful things. You're saying I was doing it wrong. Is that what you're telling me? This is better?
Well, I won't say you're doing it wrong. I'll say you were doing it inefficiently. This particular system will streamline, automate, keep track, have a transaction log for you. So you're not having to search through those 50 spreadsheets, search through those thousands of emails, worrying about saving documents for tracking. Everything is in the system for you.
Okay, well, I'm still holding on to my spreadsheets for posterity, if nothing else.
Sounds good. You hang on to them. Okay, so going forward, eCom has been designed with the end user in mind, allowing for the company to have flexibility on a range of plans. The plans can be as simple and straightforward as doing straight bit payments across all loans, or as complex as designing a plan that has tiers. With the tiers, the plans can be based on units, volume, or even a combination of both. The system also allows for overrides, bonuses, branch productions, region and team productions, as well as company-wide calculations. So what I'm going to do is jump into the system to kind of give you a sneak peek at some of the screens we have available. So during a discovery call, we learned that it took our client a team of 5 individuals with over 3.5 days to gather and document the plan types for their sales team in an audit that they were faced with. With eCom, there's no need to manage and maintain a spreadsheet of implementation dates or host a file of folders that have paper contracts. eCom will manage the commission contract implementation dates and calculate according to their assigned dates. Calculations for the plans can be based on application, processing, locked, underwriting, or funded dates. If a guarantee is in place, the calculations will be reviewed with the guarantee as well to determine the final payout. And then jumping over to the approval screen. So a distinct feature that we have in eCom that's popular among our clients is the draw recoup feature and the table of maintenance of managing the recaptures. This system will automatically calculate and apply the draw recoup until the commission is at a zero balance. So you'll see this one here. $37.79 is the commission, $37.79 is the draw that's applied, zero commission will be paid out, and the balance will be maintained in the system. The balance will be applied to the next cycle until a zero balance is shown in the system. So we have 3 distinct workflows that are available, and this one here shown offers transparency and flexibility on managing the approval processes. This particular workflow is popular among our larger base clients, as it also allows the company to open communication with their teams, as well as maintain logs on acceptances and review the requests in case of any future audits. There's no need to track emails for verifications. The system will automatically generate and populate commissions from the LOS on the assigned day. The sales or operation team member.
Oh, yeah, I apologize for interrupting you. I meant to actually ask this earlier. We're talking about LOSs, but I know you guys are an LOS consultant, so I'm assuming that you integrate with, what LOSs do you guys integrate with for this product?
So currently we have 4 that we're integrated with. We have Encompass, Lending QB, Byte, and MortgageBot. But we can integrate with any LOS that is out in the market.
Okay, great. Sorry to interrupt.
Oh, you're good. Okay, jumping back to the emails. The sales or operation team member, they'll receive an email notifying them that their commission or bonus is ready for review. If the attached document raises any concern, then the end user will simply click on Request Review to document their feedback. When the user requests a review on their commissions, they have the option to review a specific loan, any of the adjustments, or perhaps point out a missing bonus or have a second check at the draw recoup that's been applied. The feedback is recorded in eCom, and a notification is sent to the designated management team members, as well as a copy for the team member themselves. There is no hassle of having to track emails or go back and forth trying to determine which loan is in question. The transactions are also recorded in a transaction log that can be accessed at any future date if a review is requested. When the end user has reviewed their commissions and has no further questions, they simply accept their commissions and continue on with their day. Ecom will track the acceptance in the log as well as notate a review has been completed.
Aliya, just to be clear, so all of this back and forth is, you're getting out an email for it, other than, I guess, the email, you get an email notification that says, hey, go look in the system. So you're keeping for lack of a better word, an audit trail of all the information back and forth surrounding the originator's acceptance or whatever the case may be with that. So I'm sure that's great from a compliance standpoint and being able to recreate the wheel. But I had meant to ask this earlier. You can have, I know, several different margin structures that were LO comp plans set up, and does the tool track? If I have one margin plan, for October, and then I change it in November, and I change it. I've had clients run into issues with that when regulators come in and they're going through those spreadsheets that I'm so fond of to try to figure out what was in effect at that time. You probably covered it, but does the tool track all of that and preserve kind of like an audit trail of those?
Yes. So on the front end, when you access a particular loan officer or a sales team member's profile, you're actually able to see the exact plan that they were assigned, what was the start date, what was the end date, and the details are recorded and kept in here. Now, from an entry point of view, there is a transaction log that's also available more on the technical side. But from coming into the system and viewing, you can definitely see and maintain the history. So this particular plan started in May of 2016, and now currently in January of 2017, this person has a branch manager monthly bonus plan. And then as of February 1st of 2018, their personal production has increased from 100 bps to 200, and then the company is remaining the same at 100, and the branch referrals went from 10 to 100. So you can definitely maintain and track all of the different plans that have been assigned.
Great, thanks.
To wrap up the workflow that we were discussing, a PDF report is generated at the conclusion of the commission cycle for official documentation to the team members and are always available to re-pull if a particular commission report cycle is needed. This particular workflow offers the best visibility throughout all levels of the organization. Additionally, there are more streamlined workflows available in Ecom. These have less interactions across the company, smoothing out the process and cutting down on the loan officer emails. This workflow shown currently is geared specifically towards branch managers. It allows them to process and finalize the commissions. The employees will receive a confirmation email at the end of the cycle notifying them of their upcoming commission payment. And then the last workflow that we have available is preferred for our smaller organizations because it's simplified. The admin generates, processes, approves all commissions without involving different levels of the organization, allowing for a simple commission calculation process to run easy. So this last part, I was actually going to do a slide, but it's more fun to actually show you guys the dashboards that are available. So as commissions are generated in Ecom, there's two distinct dashboards available. One dashboard is available to the executive team members, and at a glance, you're able to see the top 10 loan officers, the top 5 producing branch managers, with the number of active loan officers with production compared to how many have no production. There's also an option available to drill down on the branches so you can view the team members' individual commission earnings. The pay periods that are available across the top will allow you to look at any particular payroll cycle or look at months combined or even pull up a quarter at a time to see exactly where you stand.
So, Aliya, I know that some of the mutual clients that are using this tool, this is something that really resonates well with the executive teams. And frankly, I like it because it's got colors on it, and that's always great to me. But do you find, so you were saying this dashboard is primarily for executives or branch managers will use a version of this as well?
So this particular one is geared more towards executives because it is more of a company-wide view. It's showing you your top 10 loan officers across the company, and then what are your top 5 branches. We do have a dashboard that's available more for branch managers so they can see details pertaining to their specific branch. So this one will give them stats that they're able to review their volume, units of production, as well as other indicators that they may use in determining their P&Ls as well. They can also pull up individuals within their branch to see what their commissions, draws, bonuses, adjustments, and then what their total earnings are as well. And again, they have the ability, if it's a branch manager specific to their branch only, they can see all of these stats.
Great. Now, I know we had sort of talked about how you guys have some other complementary business intelligence tools. Would I be correct in assuming that if you're using e-com and you have this data, that data obviously is going to work in conjunction with your other products and be able to pull, be pushed or pulled in to that other system as part of the offering that you're putting together?
Yes, so these dashboards are actually just a small introduction to our main product, Bullseye, our business intelligence reporting system. So Bullseye will not only capture the data from e-com, but it'll also combine the data from your LOS, your CRM, your hedging, and your financials to give you an in-depth look at your company as a whole. So if they would like to take a deep dive look at either e-com or Bullseye, they can reach out to us and let us know that they attended this webinar, and we'll get them set up.
Great. Let's see. Are you you wrapping up there, Aliya, or did you have anything else to add?
Did you have any more questions? Because I know you like to ask your questions.
Well, speaking of questions, and I'm looking at the time here, I see that there are some questions. Ian, I unfortunately cannot quite see the panel there. Do you have some questions?
I do.
That you want to bring
I do. I've got one here that says, how do you take into account overtime pay?
So Aliya and Mike, I presume that would be for you guys.
Yeah, so from the overtime aspect, so what we actually do is work with the payroll person, so whether that's your HR person, and it's actually a file that's imported into our system. So we're not actually calculating any hourly wages or overtime. We would just take the final numbers from the payroll system and then apply it to e-com, and then the deductions would be automatically calculated. So whatever is on that template that's imported is what will be applied.
So Aliya, when you're talking about taking data from a payroll system, but my guess is once you've completed all of this commission data, are you able to push that into the payroll systems as well?
Yes. So we actually have some relationships set up with a couple of payroll providers. So while they don't allow us to write to their system, we do work with a representative from your payroll company to set up a template to where e-com will automatically generate the file within our system, and then the admin or whoever is a designated person working the system, they will just download the Excel and immediately upload it straight into their payroll system. And the fields across the top are already identified, so no work needs to be done. It's just a matter of downloading and importing it to the payroll.
Okay. While we're going through some of these questions that are coming in, I wanted to give Mark and Bill and of course Mike and Aliya anything that we haven't covered that may have popped into your minds as you've heard some of the other folks speak. Anything to add?
I do want to add quickly. If the payroll provider will provide an API that allows us to write back, we definitely can set that up to integrate with e-com as well.
Okay. Along those lines, I know that, one of our, how I first came to know of you guys actually was through a mutual customer. that had been trying to implement Motivity. Now, this is for your business analytics tool, but was trying to implement Motivity for quite a bit of time, and ended up scrapping that and going with your other business intelligence tool. But is it fair to say, because you guys are also an LOS consultant, that you can get a lot more hands-on with helping the client actually find the data that they need to provide for you in their LOS system?
Mike, did you want to take that one, or you want me to jump on that?
The answer is absolutely. Yes, we absolutely can. Because of our familiarity with those LOS platforms and our experience with them, you bet.
Yeah, that's one of the things that we've found successful at MCT is going beyond just, handing a new client a list of requirements that we need, but actually taking that hands-on approach, working with them in the system. So, Mark or Bill, did you guys have anything to add?
No, I think that was great. No.
I've got two audience questions here.
Go ahead, please.
Yeah, so the first one is going to be for ATI, and that was just what's your typical setup time like, and what's the setup engagement like for ecom?
Okay, so a typical implementation time ranges from 45 to 60 days, and it is based on how many plans we're setting up, how many individuals we're adding to the system. Of course, the more there are, a little bit longer it'll take. The less there are, then the less time it takes. So you're looking at an average of 45 to 60 days.
And I think that does include some live parallel testing that we like to conduct as part of our implementation process to make sure that the numbers are squaring up.
Correct. So when we load the system, we'll load 4 prior pay cycles to compare against your reports to make sure that everything is calculating accurately. And then for 2 months or 4 pay cycles, if you're on a bi-monthly schedule, we provide support to make sure that all plans are in place, if any changes are needed, if they're set. And then if any exploring wants to be done on maybe doing some more picky plans, then we're able to set that up for you as well.
Okay, and Ian, you had another question there from the audience.
Yeah, this one's for Mark. Mark, have you seen any of your clients using LO commission floors or caps as an attempt to manage kind of this more recent issue, or just in general?
I'm sorry, I lost you there. You said managing using what?
Floors or caps on loan officer commissions.
Excuse me, I think I've got Chris's cold. I'm getting over here. But, yes, I have. I see that throughout, and actually during our the roundtable we had at the Western Secondary, a lot of the people that we talked with do have caps built in. Yep.
Excellent.
That's an effective tool, and they've been doing it before this and before the current market that we're in. But I think more and more people are moving towards that.
Excellent. And then just to address a few of the last questions here as well, we will be sending out the full slide deck for this presentation, for this webinar, and as well as a recording and a blog post recap. So there'll be plenty of opportunity for you to review on your own time. And I'll turn it over to Chris to wrap up.
Yeah, I'm looking at the time here, and we managed to stay right on time here. So really just want to thank all of our presenters, Bill Petersohn, Mark Wilson, Mike Lewis, and Aliya Nurani. And I want to thank, everyone who took the time to participate in the audience today, and had some really great questions there. Ian just covered that we'll be getting a recording out here. I think the slide deck will go out later today or tomorrow. Ian, is that right?
Yeah, that's the plan.
Excellent. And in the interim, obviously you'll have everyone's contact information on those slides. But in the interim, if you have any questions about anything today, you can reach out directly to me, and I can put you in contact with any of the folks that participated today. And hey, you know what? 11 o'clock on the nose. That's pretty darn good. So I'll just say, hey, everyone, have a wonderful day. And thanks again so much for participating. Take care now.
Thank you, everyone.
Thank you.
Thanks so much, guys.